moving their economies up the value chain, whether it's Indonesia with the EV ecosystem or Vietnam with China Plus One?
The good news is everyone is doing their part of job and competing with each other and try to attract as much FDI attention as possible. As JP was just highlighting before I started talking, FDI normalization has started happening, and this is all linked to the global growth slowdown as well as dollar started appreciating over the last 1 to 2 years, and hence we are seeing that the easy money through FDI, which was coming now, that is getting away. And it is very much important for ASEAN countries to move up the value chain and move up the game rather than just looking for a fabrication or a low-end job. Interestingly, when Vietnam was thinking about tech and going on the AI side, Indonesia and even I will say Thailand are thinking about EV. Now EV not just related to making battery and stuff, even making end-to-end car and even achieving a dream, having their own assembly line and delivering to the people. In case of Malaysia, they wanted to be like inline part of supply chain partners to Taiwan, to even Korea or even to China. And we are seeing all the tech hardware company coming and setting up their shops in Malaysia. So all in all, I'll say it's a very close battle, but four standout economy, if I have to highlight in terms of moving up on the supply chain, I'll say Malaysia, Thailand, Indonesia, and Vietnam. These four are seeing a lot of traction from foreign direct investment.
Mr. Batra, this is JP. I want to go back to that particular chart where we looked at the policy rate differentials because a lot of investors demand a premium to invest in emerging markets because of the potential risks. And perhaps it's no surprise or no coincidence that Malaysia and Thailand are two of the worst performing markets in Southeast Asia because of that negative rate differential. I want to ask you, as an investor itself, what is a preferred or sweet spot premium for these emerging market rate differentials in order to entice investors and foreign direct investors to come back in to these various markets? I know it's not a one-size-fits-all, but is there a particular range or a preferred rate differential versus the Federal Reserve's policy rate that's preferred for that might convince foreign investors to come back in and say, you know what, maybe now is the time to come back to Southeast Asia, that premium is sufficient?
So JP, three things usually foreign investors look when they want to invest into our markets. Number one is the growth differential. If we offer them the premium growth, they will literally give a lot of money to us. The second, what you have highlighted, is a rate differential. Or the third thing is if somebody is trading at a very distressed valuation and that offers them a multi-bagger return if they invest right now in this place. Sadly, all three factors are not available at one go. Either one or two factors are missing. But coming back to your points on the rate differential, if we look at an EM broad level, rate differential versus the Fed, that is the pre-GFC era, the average or the median number used to be around 400, 450 basis points. But you can give me a pushback and say that last 10 years, the balance sheets in emerging market in ASEAN have become quite resilient and fortress. So we can say that differential then can fall down to 200, 250 basis point. But looking at what the competing region like Latin America or I will say CEMEA and Africa providing a very high interest rate differential compared to the shallow differential which is being offered in our part of the world, that does not give us much room when the difficult times arrive. Here, when I'm talking about difficult time is if let's assume Fed needs to start hiking again. That's where you don't know where's the basis and how much differential you have settled in right now. Or second, we all are hoping rate cut to arrive, but if rate cuts keep on delaying further, that makes investment decision or even FDI decision delayed from this investor. So there's not right fit and right answer because post-COVID world, all the correlations and model forecasts have broken. So I will say that if pre-GFC, 350, 400 basis point, post-GFC, 200, 250 basis point, that has been the case. But post-COVID, not a very right answer is available at this juncture.
Hi, I'm Emily Tan, and thanks for watching CNBC. You can check out more of our videos by clicking on the boxes on the screen. And don't forget to subscribe to the channel for more. Thanks for watching.